I don't know if you noticed, mate. Did you hear about the war?
I heard something the other day. Yeah, there were a couple of posts on Twitter/X that seemed to be moving markets from everybody's favorite president. Yeah, 100%. We're seeing input costs. I mean, across the board, and that's not unique to uranium mining operations. That is going to have a slightly delayed effect on the pounds that they're selling, but certainly it's not going to be lowering prices. Any projects that were already kind of on the marginal side of things in terms of costs are going to have to ask for more money when they deliver those pounds. So that's a pretty obvious kind of initial take. Sulfur is definitely impacted. You know, almost half of the world's sulfur exports come through the Strait of Hormuz, which is huge.
This is general advice and my opinions only. CFDs are high risk, past performance isn't reliable. I may be long or short CFDs and stocks mentioned. Content may contain language that offends some viewers. LEVRD operates as corporate authorised representative 001318377 under AFSL 548573. You can find our financial services guide via the LEVRD website link in the show notes.
Righto, punters, I'm back where I feel comfortable. Uranium and the main man, the Huhn, let's just say the premier uranium subscription service in the world, Uranium Insider, and possibly YouTube's most prolific interviewee, Justin Huhn. Welcome, mate. Welcome. It's a green day.
I'm very happy to be here with you, Matty. Thanks for having me.
No worries, mate. Now, uranium, the trade, is it consensus now? It's ripped a lot since I've last spoken to you, but would you say it's sitting where it should be?
Yeah, it's had a good run. Kind of Q4 into the first month of this year, it had a really, really solid run. I would say that there's a pretty strong industry consensus that we've got a concerning supply situation going out late decade into the early 2030s, and even the utilities at this point are paying attention here, which is, you know, a very good sign and sort of not something we've really seen since we've been following this market. There's some active, how do you want to say it, kind of tension, let's say, amongst utilities in the industry in general. So there's a lot of weight on some undeveloped projects, and it seems that most in the industry believe that we're headed for higher prices, and that's amongst the people in the industry, not the investing side of things. So in that way, it's kind of consensus, I suppose.
Yeah, because if you look at equities have gone up, terms gone up, spot hasn't really taken off. I suppose the big things that have, you know, nothing's really changed yet significantly, like the AI, the data center side of things, the thesis is there. Next gen's been permitted, but there hasn't been, it seems the equities have caught up a bit compared to a year ago.
Yeah, for sure. The equities, I would say, starting about August into September last year, the equities started to move prior to the price of uranium. So they started to kind of look over the valley and price in higher prices. There's, of course, been a decent sale over the past, 6 weeks or so, where we've seen the ETFs pull back about 30%. Some of the equities, some of the small caps have been chopped in half, but most of the large caps have held up decently well. So you could argue that at 83, 84 here, spot 90 term, some of these things are fairly priced. Some are undervalued on a relative basis. Some are severely undervalued on a relative basis. And there's a few that you could argue are overvalued here. So on an individual basis, they're kind of all over the map. But as far as the rest of the sector as a whole goes, it seems right now that there's sort of just kind of this bored complacency. It's the sentiment isn't terrible and it's not great. It's just kind of, we all get it. We're just now waiting for the price to move again, and we'll see those flows come back to the equities. But we saw the flows come in really, really strongly today, despite the fact that there wasn't really any news on the uranium front. Just kind of markets were risk on for a brief moment here today.
Yeah, well, we're going to get into stocks. We're going to get into what's overvalued, undervalued, and how to even enter this trade, in which direction. But I don't know if you noticed, mate, did you hear about the war?
I heard something the other day. There were a couple of posts on Twitter/X that seemed to be moving markets from everybody's favorite president. So
could be finishing. Could be finishing. Who knows?
Well, if I recall, he took a victory lap after the first week, and here we are at a month in. So it's, I don't know. As of a few days ago, it did seem like President Trump was sort of losing a little bit of power over the narrative, posting on Truth Social that got passed around everywhere else that the market didn't really believe what he was saying. Then, news last night from the Wall Street Journal that he would consider ending the war even if the strait remained closed. And then more stuff came out today. The markets went huge up. But really, I mean, it's pretty uncommon to see 2-3+% moves for the broad market, for the Qs, for the S&P, for the Dow in a bull market. It's usually oftentimes you see these types of moves that are kind of dead cat bounces. So I don't know. We'll have to see what happens in the coming weeks, but I'm skeptical that things are all good and about to just move back to kind of a grinding higher sort of typical broad market.
Very much, mate. I want to hear your take on how you think this war is or has flown into uranium, because it's not like you can just start buying uranium now and create more power to offset any diesel shortages. I don't believe that's the case. My take is there could be an input shock into operations, like with diesel and sulfur. How do you see from your end the effect of the war on uranium equities and the market overall?
Yeah, 100%. We're seeing input costs, I mean, across the board, and that's not unique to uranium mining operations. That is going to have a slightly delayed effect on the pounds that they're selling, but certainly it's not going to be lowering prices. Any projects that were already kind of on the marginal side of things in terms of cost are going to have to ask for more money when they deliver those pounds. So that's a pretty obvious kind of initial take. Sulfur is definitely impacted. Almost half of the world's sulfur exports come through the Strait of Hormuz, which is huge. Sulfur, of course, is oftentimes converted to sulfuric acid and used as a reagent in mining, as you well know. And not all uranium projects utilize sulfuric acid. The big one, of course, is Kazakhstan, although they have mostly their own domestic supply for the uranium projects. The little that they do buy usually comes from Russia, not from the Middle East. So they seem to be in an okay position. Perhaps the costs are likely rising because the countries that are producing sulfur and sulfuric acid are more likely going to be selling that at a premium to the countries that need it, that aren't getting it through the strait. So that's but Africa, the African projects, in particular the Huhn project in Namibia, is very reliant on sulfuric acid. They import sulfur and convert it to acid themselves. The Chinese do that operate that mine. And it's kind of unknown how much inventory they have. I think a simple take would be that a few weeks of disruption is probably not a big deal. A few months is probably a bigger deal. So how much impacted, we haven't really seen that yet. But Huhn in Namibia, to some extent, Rossing. Langer Heinrich uses a different reagent. And then probably we could see some impacts to Kyalakira in Malawi, which is kind of in ramp up production right now. Besides that, it's just mainly kind of pricing pressure based on input costs would probably be the easiest take. I think really the bigger story is more of a mid and long-term delayed reaction in terms of sovereign strategic energy supply and the considerable strategic asset that nuclear can be during a time like this.
Yeah, we're going to get onto Kyalakira. Tell you what, that's a very interesting case. And Jesus Christ, I've been burnt by things that have been hated because they can go up quickly as well. Hard rock versus ISR, mate, in this market. Hard rock, you've got, you mentioned a lot of hard rock operations there that use both a lot of diesel to haul the material and sulfur to process. ISR, not as much diesel reliant, but reagent reliant. Which ones do you think might be the safer play during this period if there is input issues, both on the cost and supply front of not getting it, or
Sure.
Once you get it, paying a shitload for it?
Sure. Well, that's kind of a tricky question because the reliable producers that are hard rock producing that are not necessarily using acid as a reagent, or sulfuric acid specifically, oftentimes are delivering into long-term contracts that have fixed price elements. And the market price hasn't necessarily moved in terms of the spot price based on this particular situation with the war, with the Iran war and the closure of the strait. So, and part of that is that the spot market has been so influenced by the financial markets in recent history that when you have risk off markets, you oftentimes have the buyers kind of step back and see if they can take advantage of that momentum to the downside, in particular utilities. So it's hard to say. I honestly expect at some point this situation will resolve itself somehow. And so, the mid to the long term for any projects that are reliant on sulfur and sulfuric acid, they'll probably be okay. So hard to say what to bet on right now based on this situation because I don't know if it's going to be resolved tomorrow or in 6 months. I really have no idea.
Mate, I want to get into the stocks. We're going to stick to the ASX ones and we'll obviously talk next gens on the ASX. We want to talk Cameco as well. But I want to start with, tell you what, we mentioned it before, down 40% in 1 month, Lotus. They've done their little saviour raise to get them through. From what I hear, like to get the uranium out of Malawi to the converter and get paid for it is like a very lengthy process. And then you couple that with what's going on at the moment because they're in transition between needing sulfuric acid to needing sulfur, going towards getting their own plant commissioned. Right. A lot of headwinds for them, but far out, I guess, for what they're producing and what their market cap's been deteriorated to. How are you viewing the stock at the moment?
Sure. So I don't want to get too deep into individual companies just because that's, oftentimes this is conversations that happen behind the paywall for the newsletter. But this is an interesting story because not only because of the sulfur situation, because it's a development story and there really aren't very many companies trying to do this. So historically speaking, over the past couple of years, the companies that have gone from a mining company sitting next to a hole in the ground to actually trying to pull something out of the ground, almost all of them have been severely punished by the market for that effort. So, and Lotus has been no exception. So yes, they're in Malawi. It's a relatively stable jurisdiction as far as Africa goes. It's a previously producing mine at Kayelekera. They've been going through the process of ramping up production over the past year or so. They have been importing sulfuric acid through a port in South Africa and sending it north via truck for something like 1,800 kilometers, or it's possibly even more than that. It's a massive distance that is very, very tough going in Africa, as you can imagine. They are building their own sulfuric acid plant, and like you mentioned, they will be able to import sulfur rather than the acid itself through Tanzania, which is much, much closer. So there's a port that's much closer than South Africa to the project. They've had a couple of issues. One of that is the disruption in the shipping of the sulfuric acid. They've had all kinds of problems with that. Another one is they just recently had an issue with tainted water at the mine, and some of the workers got ill. This obviously doesn't look great for the company, but it does look like something that probably will be shored up, and this too shall pass kind of thing. News literally came out about 15 minutes before we got on this call that Lotus released in the press that they have had their first shipment of uranium reach Orano's conversion facility, and it has been approved by Orano.
Yeah,
so that's a very, very big first step for the company. They still have some challenges in the ramp up. It's not easy. It's not an easy jurisdiction. It's not an easy process to begin with, even in the best jurisdictions. So with that said, I mean, the stock is unbelievably dirt cheap. I honestly think if they can prove that they can get back up or get up to that nameplate, which is between 2 and 2.4 million pounds a year of production, it's a screaming buy, a screaming takeout target. They just need a little bit of momentum of things going well for them, and I think the market will appreciate that eventually.
I'll just scrap every further question I've got on individual stocks and encourage everyone to go subscribe to your paywall because that's where the action is, and they're all good questions. And the only way you're going to find out is if you pay Huhn a bit of cash. So highly recommended. I've been a subscriber before, mate. Where's the bottleneck at the moment? Where's most of the action occurring? Is it on the U308 production side, the conversion, the enrichment? Where you talk to a lot of people in the market, where is the action and the bottlenecks at the moment?
Well, within the fuel cycle, I would still argue that the biggest bottleneck is still in conversion, although I'm not in the camp that it's such a worrisome bottleneck that it's actually impeding on uranium contracting. I'm not exactly in that camp. With that said, we do know that ConverDyn is expanding their production, which is a very good sign. There's also another entrant into the space. Off the top of my head, I'm forgetting their name, but they're planning on building a conversion facility in the United States, so that's very good. Going out a few years into the future, which is really where the industry lives at any given moment, the utilities aren't buying for next week. They're buying for 2029 and 2030, 2031 and beyond. U3O8 is really the biggest problem. And the reason for that is that there's minimal above ground mobile inventories and secondary supplies that will act as a buffer that have historically been huge in this industry, even in the previous bull market, in, 04 to 07, where the price went from, $10 a pound up to 134 over the course of about 5 years. Even during that market, we had a lot of underfeeding from enrichment. We had secondary supplies coming through from megatons and megawatts, down blending from Russia, a huge amount of mobile inventories hanging over the market, and still we had a raging bull market. Now we're in a situation where the industry is utterly reliant right now, and especially when we get late 2020s, early 2030s, on pounds literally coming out of the ground. And importantly, going into the 2030s, from projects that haven't even put a shovel in the ground yet. So this is unprecedented territory for this industry. It's quite literally unprecedented, with the exception of the initial ramp up of commercial nuclear. So going back to the 60s, that's when the first reactors were dependent upon pounds coming out of the ground. And since the 70s, that has never happened until now. So that's what we're looking at going forward. As far as the fuel cycle goes, price is going to incentivize sufficient supply. There's new entrants coming online for both, for everything, for uranium mining, for conversion, for enrichment. And I generally believe in kind of the global commercial industry, that when the demand is there, supply will arrive. The problem with the mining part of it is that it just takes so very, very long from discovery to development to production. The price has to be there for that to happen.
So the big dogs you can play this by, like Cameco and NextGen, two very different companies at the moment. Like, NextGen's still got an easy plus $1 billion funding gap, trading at, probably 2 times MPV on the market cap. But then, and not going to produce till early 2030 at best, and a lot of work to do. But then you got Cameco on the other side with the first step to needing all this U3O8 is building the reactors, and they have a huge exposure to that. And Grant talks up the EBITDA they get per reactor. How do you look at them side by side as, a bit of a uranium staple play, where Cameco might be really starting to benefit before any other company on a revenue basis?
Sure. Well, Cameco is sort of one of the only real vertically integrated companies in this space. They have uranium mining, they have conversion at Port Hope. They have exposure to enrichment through their 40% ownership in Global Laser Enrichment, which they can move up to 75%, I believe, and which I believe that they probably will. They've been talking it up in a big way in the past few conference calls. And they have fuel fabrication through Westinghouse, and then they have reactor construction and reactor potentially operation through Westinghouse. There's a recent interview with Tim Gitzel, the CEO of Cameco, who basically was speaking highly confidently of the likelihood of these 10 large reactors to be built in the United States, AP1000s. So we are expecting that news to likely hit, which will be, I think, a decent catalyst for the industry and Cameco, of course. But the Cameco, on the uranium side of things for Cameco, is very, very interesting. And this is one of the elements of why we believe that the supply story for uranium is such a big piece of the bullish thesis. So Cameco has joint venture projects with Orano and Saskatchewan, both Cigar Lake and McArthur River, both the mines and the mills. Cigar Lake is done in 2035. McArthur River is done in 2041, 2042, maybe earlier if they decide to ramp it, which they probably will. So basically by 2040, their two biggest producing assets, and the two biggest producing assets, uranium assets in the world of any company, will be done. And what do they have in their pipeline currently? Well, they have a number of tier 2 assets that are idled, right? They can restart Rabbit Lake if they get a new tailings facility. They've got some ISR stuff in the US that's a few million pounds a year if they ramp that up. They've got a few other large deposits they haven't really touched. But besides that, there's nothing really in the works for them on the development side to replace Cigar Lake or McArthur River. And so we're going to have to see them act on that front in the coming years, and especially for Orano is in even a tighter pinch than Cameco is. But the point I'm trying to kind of bring home here is that we've heard kind of some hints from the company in past interviews from both Grant Isaac and Tim Gitzel in their conference calls, their most recent one especially, that you do sort of see this vertical integration kind of coming together. It does seem likely that some or a significant percentage of the production of uranium by the company is going to be dedicated as fuel for the reactors. And they could be sort of the uranium one of the West, or the Rosatom of the West, which, Rosatom makes these nuclear plant export deals where they build the plant, they train the workforce, they supply the fuel, which means uranium conversion, enrichment, fabricated fuel. They deal with the waste, and eventually they decommission it 80 years later. So it looks to us like Cameco is kind of setting themselves up in that manner. And if any percentage of their future production from Cigar or MacArthur or whatever else they end up developing in the next decade is committed to their nuclear builds, that is great for them. That's a problem for utilities that are relying on whatever Cameco or Orano are going to do to replace Cigar and MacArthur.
Could they buy the remaining 51% of Westinghouse?
That's a good question. I can't really say if it's technically possible off the top of my head. I don't know that Brookfield wants to sell it. I think that it seems to me like they're pleased with their positioning currently. But, if they grow to a large enough size where the valuation makes sense, then maybe that's something they can entertain. I'm not really sure.
They could become like an NVIDIA, like they become the supplier of all the plants and then, create a bit of a circular economy to get the uranium to feed them. Because it might be safer building reactors than actually developing mines in this, because that's friggin' hard to do.
Very, very hard. Yeah.
Yeah. Mate, the biggest risk to the uranium market at the moment, and you cannot say a reactor meltdown.
Oh, well, this is easy because it's very similar to a reactor meltdown. Something going on with a hot conflict in the East. I mean, right now, it's who really knows what the IRGC could do in, let's say, the death throes or them being in survival mode. It's very obvious that the UAE has sided with the United States in this whole situation, and the UAE has 4 gigantic reactors right on the other side of the strait from Iran. So it's something, I think it's unlikely. Of course, it doesn't make logical sense to try to send a missile towards your neighbor's reactor, because obviously there's this thing called wind, and that would not be very good for you or your country or your people. But again, if we're dealing with an entity that is literally faced with their own survival and they're grasping at straws, I don't really know if that's 100% out of the question. So that would be very bad, obviously. That would be terrible for sentiment in the short term. And if it actually led to a slowdown in nuclear builds or demand destruction like Fukushima did, then that could actually usher in some mid or potentially long-term bearishness. So that's obviously top of mind here. I'm not super concerned that it comes to pass. I think the likelihood is very, very low that happens, but I would say it's not zero. But besides that, I don't really see supply surprises coming out of nowhere over the time horizon that I can confidently bet on this sector, which is probably about a 5 to 7 year period. So the bearish surprises that we are not seeing in our modeling would have to come from some type of demand destruction. So whether that's China saying, okay, we've built enough reactors now, and then they just halt their build out program, that would alter our supply and demand model. Besides an accident, I would say demand destruction of some kind would be the biggest bearish element, but I just don't see it. I don't see where that would come from in the environment that we're in right now. Right now, the adoption is increasing, the build outs are increasing.
Do you think the American tailwinds, the investment in American uranium projects, do you think that are you still waiting for that to come to the forefront a bit, like around your smaller operations like Peninsula and things like that? Is that still a tailwind that hasn't really hit yet?
Yeah, I think so. And I don't really know exactly what is going to create kind of that bifurcation for the American uranium miners. The only thing that really would require purchasing of what the U.S. would call unobligated material. So for the U.S. military has to buy uranium that's produced domestically. They can't utilize any other country's uranium resource for military operations. And our understanding is that their inventories are on the low end. So military buying coming from only from uranium in the United States that's produced here would be a strong catalyst for the miners here. There's already a slight premium for settlement at ConverDyn, which doesn't really reflect in the equities. But besides the forced purchasing of unobligated material, it is still generally a global marketplace for the material. But with that said, there's clearly kind of an America first agenda coming from this administration, which should generally be positive for the miners here, not only for ease of permitting, but potentially for U.S. uranium having a slight premium coming from the buying of U.S. utilities and especially from the U.S. government, if that comes to pass.
Why would you invest in uranium instead of, say, gold? Gold, you can pour a gold bar, drive it to the mint. Everything we talk about today is highlights the complexity of producing and selling uranium. Why? And you've obviously picked uranium as your paywall.
Sure.
Is it a difficult sector to invest in with all the headwinds and the surprises that we see in a lot of operations, or why do you love it so much?
I love it because it's something that you can actually model with high confidence. It's a small sector. It's a small industry. There's not a lot of companies. There's not a lot of companies that are real companies that will eventually produce some kind of cash flow. You can count on both hands, most likely, that are publicly traded. As far as uranium versus gold, I would just say yes, and I own both. But what is unique about this sector is that uranium is a fuel that cannot be replaced. And if you can model out the actual demand coming from reactors and the expected demand coming from reactors in the coming years, this is a material that has to be purchased. It's not discretionary. It is a must. And the utilities they're not price insensitive, but they can't not buy the fuel. So you can't be a fuel buyer for a utility and just not procure the fuel for that reactor. That's not an option. These are multi-billion-dollar, very important, very strategic assets. In many places like the United States right now, there's long-term power purchase agreements. So for, Vistra or Constellation or Duke that have signed 10 and 20-year power purchase agreements with some of the tech companies, they're not going to let their reactors go unfueled. So if uranium is $100 a pound, if it's $200 a pound, they'll pay it. They might not be happy about it, but they will pay it. So you have sort of a forced buyer of this material that literally cannot be replaced. And so it's kind of a captured market. And if you can, and it's small enough, it's not an easy task, but it's a doable task to model out all of the reactors and all of the supply projects in the world, which we have done. And then from there, you can have a very, very highly confident bet, one direction or another. But as far as we're looking at it right now, it's clearly bullish.
We won't talk about stocks in the future, but we might be able to squeeze one in about stocks in the past.
Sure.
What has been your biggest disappointment from a stock perspective of who has said they're going to do something, haven't, and eroded possibly your coin and others? Give you a couple of year time frame.
Well, I wouldn't say, without actually picking a single stock, I can speak more generally. I would say that I am surprised that at this far along in the market, right? So the commodity bottomed in December of 2016. 2016. It's been just over 9 years since the bottom of the commodity. You could argue it isn't a bull market until it's broken out of some technical resistance or it's above the cost of production, right? Okay, so let's say it's been a bull market since 2019 or 2020. This is many, many years into this thing. I am surprised that we have not seen more of an outperformance by small and mid caps, because that is typically what you see in the later innings of a resource bull market, right? Usually you see the large caps kind of move first, the big money comes in, that's what's liquid, and that's what kind of drives the sector. We've seen that multiple times in this sector. What we haven't seen is kind of a euphoric frenzy where money just flows into absolutely everything with uranium in the name. I am surprised that has not happened yet. I'm confident that it will, but it's just been a very, very long bull market. And the crazy thing is like looking back, I've been following this since 2017. Looking back at all of the years that have passed for this market, And I can still, from this point in time, say this is a very compelling investment thesis. I don't see where this price stops, because you can reach that incentive price, 110, 115, whatever it might be right now, especially with the higher input costs. And then you get to a price where we expect to see multiple utilities competing for a limited number of pounds, and the incentive price goes out the window. So I'm highly confident this is going to breach the previous highs of the past bull market. And that was inflation adjusted $200 a pound here. So I think that's where we're headed. I feel confident in that bet. The hard part about this, to kind of answer your previous question, is keeping tabs on the physical market, because the information is not very free flowing on that front. You have to have industry contacts. You have to have services behind very expensive paywalls to get access to this data, which we do. And that is something very useful that we can distill down to our membership. But just the spot price is what everybody sees, and that can create very volatile movements in the market. But with that said, I've been disappointed in the past to see robust moves in the sector without really seeing the small and mid caps kind of catch a serious bid. With that, at the same time, that's something I suppose we have to look forward to.
Now, if anyone's listening and they want to know, I was going to ask the most underhyped and overhyped uranium names, but I think it'd be more appropriate that people head to your paywall and offset some of those subscription costs you have to provide them a good service. And I'm sure you'll tell them behind that, mate. Thank you very much for coming on. That was great to get a bit of a uranium update in this highly volatile market, Huhn.
It's a pleasure. Thanks for having me. I'm happy to come on again.
Well, don't say that. I'll be ringing you all the time.
All good.
Thanks, mate. Cheers.